Good morning, good afternoon, good evening, Sip&Talkers, wherever you're tuning in from.
Hello, everyone, and welcome back.
I'm Joe, and we have gathered a mountain of analysis to give you a real, in-depth guide to the 2026 economic outlook. We're going deep on AI, the markets, all of it. It's going to be a packed one today.
It absolutely is. But wait, Joe, before we get into all that, we have to talk about something that's been heating up. Just the other day, we mentioned how angry China was with Japan over Prime Minister Takeshi Sane's comments on Taiwan.
Right.
And it seems like that situation has gotten, well, a lot more intense, hasn't it?
Oh, it really has. So, you know what? Before we officially kick off today's main topic, let's just quickly break down this situation because the logic behind it is actually crystal clear. We're talking about why Japan is even taking this stance on Taiwan in the first place.
Mm.
A lot of the commentary you see out there just says, oh, Japan supports Taiwan. But that's only half the story.
It's barely half the story.
Japan's position isn't just some, moral high ground thing. It is a very, very pragmatic decision that is based entirely on its own national interests. It's a responsible choice for them.
And there's a huge irony here, but it's also the most realistic way to look at it.
What's that?
The ones who want war. It isn't Taiwan, it isn't Japan, and it's certainly not us here in America.
Right.
The one pushing for expansion, the one threatening others with force, is the Chinese Communist Party. They're the ones trying to force their will on everyone else.
They're trying to change the status quo with intimidation.
Exactly. And yet, Japan gets painted as this super evil villain by the Chinese government. It's absurd, isn't it?
It's completely absurd. The logic is like when a teacher in elementary school says the next person who makes trouble is getting detention.
Oh, I know this one.
And you know who gets mad when they hear that?
It's always the kid who is already planning to cause trouble.
It's always the troublemaker. Exactly. So, okay, let's not get too worked up. We have to stay calm and objective here.
And they even put out a statement saying Japan's public safety is poor and that Chinese citizens shouldn't travel there. It's just wild.
It is wild. Okay, so for today's Sip and Talk, we'll start with this idea of morality versus national interest, and then we're going to dive right into our main event.
Let's do it.
We're talking about the 2026 global economic forecast, the next big wave for the AI industry, how AI is actually going to fit into our lives. We get this great elevator analogy for that, and all the market signals coming from this great power competition.
Sounds good. Let's get into it.
All right, let's unpack this. We're steering the conversation toward the 2026 AI and economic blueprint, and it's really defined by what you could call a triple threat.
Okay.
It's three massive converging megatrends that anyone in the market has to navigate at the same time.
And these aren't just small shifts, right? We're talking about huge tectonic movements in where capital is flowing.
Exactly. So threat number one, and this is the core of our whole discussion today, is the AI revolution hitting its physical limits.
The exponential digital demand running smack into a linear physical supply.
Precisely. Then threat number two is total geopolitical competition. The fight is moving beyond just microchips and software. Now it's about tangible resources, defense, commodities.
Yeah, and the third threat.
The monetary system trust crisis. This is all about debt, currency devaluation, and that flight to hard assets we've been seeing.
Before we get into the AI infrastructure, which is a huge topic, let's maybe start with the immediate volatility in the market because that's really rooted in that third threat, right? The global liquidity squeeze.
Absolutely. The global liquidity pressure is what's driving all the short-term turbulence. And you have a few pressure points all hitting at once. You've got the Federal Reserve's quantitative tightening, or QT. It's still happening. It's still sucking money out of the system, even if we're getting near the end of it.
And then there's the government's own bank account, the Treasury General account, the TGA.
Right, which acts like this giant holding tank for cash, keeping it from actually getting out into the broader market and circulating.
So when the Fed is pulling reserves out and the government is basically holding cash hostage, you see interbank lending rates start to spike. It's a clear signal that things are getting tight.
And that's exactly the kind of environment that exposes all the fragile parts of the system. Which brings us to that famous warning from JP Morgan's CEO, Jamie Dimon.
The cockroaches.
The cockroaches, yeah.
Yep.
The hidden risks.
Yeah.
And they're mostly living in the non-bank financial institutions, the NBFIs.
And why are they so much more dangerous?
Well, because after 2008, the traditional banks got hit with heavy regulations. But the NBFIs, they're not subject to the same strict capital reserve rules. So they can be highly leveraged, their books are opaque, and they're holding risks that nobody can really see or price correctly.
And the most explosive risk they're holding right now seems to be commercial mortgage-backed securities, CMBS, all that commercial real estate.
That's the ticking time bomb. With interest rates so high, all these fixed-rate loans are coming due, and they have to be refinanced at much, much higher rates.
Yeah.
It's going to lead to a wave of defaults.
And if those defaults cascade through the CMBS sector, you could see a chain reaction of failures among all those interconnected NBFIs.
So if you're managing any kind of portfolio, the first big thing to watch for is the definitive end of QT.
Right.
The moment the Fed provides that liquidity relief, you could see a big rebound in some of the tech and AI stocks that have been beaten down, especially the cloud service providers, the CSPs.
But you have to keep one eye glued to that commercial real estate risk.
You have to. Because if the CMBS defaults start to spread, it could trigger a systemic credit freeze that would just crush all risk assets in 2026, no matter how strong the AI growth story is.
Okay, so that covers the liquidity foundation. Now let's do that hard pivot to AI investment 2.0, the big shift to physical constraints.
This is a huge shift in thinking. The core insight here is that AI investment is no longer a cool new thing. It's become a survival imperative for businesses.
Right.
But the focus is rapidly, and I mean rapidly, moving from the software, the algorithms, the models, to the physical stuff, the hardware, the power, the infrastructure.
And you can't have that conversation without talking about the king, NVIDIA. They've absolutely defined this whole era.
They have.
But their dominance, and especially those, astounding 80% gross margins, they're facing some very real structural threats that point toward normalization.
Yeah, let's unpack that, the NVIDIA valuation remodel. The first threat is just the falling price of compute.
It's like Moore's Law on steroids.
Exactly. Technical breakthroughs mean that the same amount of computing power costs less and less over time. A huge example of this is the move from FP16 data processing down to FP4.
Which basically means the chip is processing data 4 times more efficiently.
Right. And what does that mean for an investor? NVIDIA sells hardware. If the efficiency of that hardware quadruples, the price you can charge for 1 unit of actual computing output just plummets.
So they have to sell way, way more chips just to keep their revenue on the same trajectory. That puts enormous pressure on their pricing power and those incredible margins.
And then there's threat number 2, ASIC competition, application-specific integrated circuits.
The big boys are making their own chips now.
The biggest boys. Google with their TPUs, Amazon with their Inferentia chips, they're designing custom silicon for their own massive internal workloads.
So they're just bypassing NVIDIA for certain parts of their tech stack. That forces real competition and starts to bring those margins back down to earth.
We saw a really interesting signal from SoftBank recently, right? They sold off their NVIDIA stake to double down on OpenAI.
That's a huge tell. It's the market saying the smart money is moving away from the current hardware champ and is now actively looking for the next source of monopoly power. Maybe that's in the model layer or the application layer.
So the consensus seems to be that while NVIDIA will still be a giant, their revenue growth might settle into a more, normal 25% a year, and those 80% margins might come down to the 60-65% range long term.
Still wildly profitable.
Oh, incredibly profitable.
Yeah.
But the era of them having near monopolistic control over pricing is probably coming to an end.
And this whole shift in the hardware conversation is exactly why the physical barrier is now the main bottleneck.
It is the bottleneck. AI compute demand is exponential. We want bigger models. We want faster training yesterday.
But the supply of the physical infrastructure, the power, the grid, the cooling, that's totally linear. You can't speed up geology or permitting laws.
And the most concrete example of this is the grid interconnection wait times. We're not talking about getting a quick permit anymore.
No.
In some major markets, the wait to actually plug a new data center into the electrical grid has gone from maybe 2 years to 5 or even 8 years.
8 years, that's an eternity in the tech world.
It is. And if you can't get power, your billion-dollar chips are just expensive paperweights. This is the single biggest short-term constraint on AI growth, period.
Which means the golden investment chain for the next few years has to be focused on solving these physical problems.
100%. Okay, link number 1 in that chain, energy.
Data centers are just unbelievably power hungry. We're talking gigawatts of reliable 247 power.
Which is forcing this huge pivot toward nuclear power technology, specifically small modular reactors or SMRs and the supply chains that support them.
Nuclear gives you that stable, low-carbon, super-dense energy that the AI giants need to meet their power demands and their ESG targets.
Okay, link 2, the power grid itself.
The U.S. grid is old.
It's ancient. It's like 40 years old on average. It needs a monumental upgrade to handle both the new AI data centers and the flood of renewable energy coming online.
So the investment focus here is on the grid equipment manufacturers, the companies that make the big-ticket items.
We're talking large-scale transformers, high-voltage switchgear, gas turbines, the heavy metal.
And the crucial thing for investors to understand here is the lead times.
Oh, the lead times are insane. Heavy electrical equipment like these transformers already have backlogs of 3 to 4 years.
So the companies that control that manufacturing capacity are basically sitting on a guaranteed, highly profitable, multi-year book of orders. That demand isn't going anywhere.
And that brings us to link 3, cooling.
This is a big one. The newest GPUs are drawing over 1,000 watts of power each.
1,000 watts. Just think about that. Air cooling. It can't handle that kind of thermal density. Not efficiently. Your operating costs would go through the roof.
So high-efficiency solutions are becoming mandatory, not optional. We're seeing this massive acceleration in the adoption of liquid cooling.
Specifically, direct liquid cooling DLC and also immersion cooling, where you literally submerge the hardware in a non-conductive fluid.
DLC is expected to just dramatically increase its market penetration by 2026. It's a necessity to manage the heat and keep the data centers efficient.
Now, this doesn't mean you should abandon hardware investments entirely.
No, not at all. You just have to be more selective. The focus should be on the parts of the semiconductor chain that still have what you could call defensive monopolies.
Proprietary technologies that are essential for the manufacturing process itself.
We're talking about things like the equipment and materials for extreme ultraviolet lithography, EUV, which you need for the most advanced chips.
Or advanced packaging equipment. These are technologies that are super proprietary, incredibly hard to replicate, and they're essential no matter who makes the final chip, NVIDIA, Google, or Amazon.
And even on the architecture side, the path forward isn't set in stone. The LLM approach is being challenged.
Right. You see these internal debates at places like Meta, where someone like Yann LeCun is questioning the whole philosophy of just scaling up LLMs bigger and bigger. He's advocating for things like world models, which could be much more efficient.
And that push for efficiency is driving new models, like China's DeepSeek R1.
Which got extremely high performance, using way less compute power.
Right, because it used a smarter architecture, a technique called GRPO, Group-Wise Restricted Parameter Sharing. It lets the model perform at a high level without that brute force computational power of the giant general models.
So the takeaway for investors is to look for the new infrastructure that enables greater efficiency and lower cost, because that's where the next wave is going.
The physical world is definitely fighting back against the digital boom.
It really is.
Yeah.
And once you solve for those physical bottlenecks, you run right into the psychological one.
Ah, yes.
Which brings us to section 3, the AI elevator revelation. This is honestly one of the most important concepts in the whole blueprint because it connects the raw technology to human psychology.
It asks that fundamental question: why are people so reluctant to adopt a revolutionary technology, even when all the engineers swear up and down that it's perfectly safe?
The classic story here is Elisha Otis, back in 1854 at the New York Crystal Palace.
Right, the World's Fair.
Otis stands on his elevator platform high up in the air, and he has an assistant dramatically cut the rope with an axe.
And the safety brake engages instantly. The platform just stops.
It stops. The technical threshold, can it do it, was met. The elevator was proven to be safe.
But people still refuse to ride the thing.
They wouldn't get on it.
Yeah.
And the research shows it wasn't because they were still afraid of the rope breaking.
It was something deeper. They were afraid of the loss of control. They couldn't see how it worked. They couldn't intuitively judge the risk. It was a black box.
The core psychological barrier is that fear of the loss of control. So Otis realized he wasn't just selling technology, he had to sell trust.
And his solutions were pure psychology. The first one was the mirror.
The mirror. It had absolutely nothing to do with the engineering or safety of the elevator.
Not a thing. But if you're standing in a small enclosed box, your anxiety naturally goes up. The mirror gives you a distraction. It makes the space feel bigger. And it completely shifts your focus from worrying about the machine to, checking if you have something in your teeth.
It was psychological safety by design.
Brilliant. The second trick was the music.
This is super early effective engineering. The music wasn't technically necessary, obviously, but it eased that psychological impatience.
When you're distracted by a pleasant tune, your perception of how long you've been waiting changes. It reduces the anxiety you feel from being trapped in the machine.
And the third, and this might be the most important one, was the operator.
The human trust agent.
Yes. Even though the operator didn't actually control the key safety features, that was all automatic, people trusted a human presence more than they trusted in the machine itself.
The operator provided a sense of accountability. They were the bridge between the scary, unknown machine and the skeptical passenger.
And this is the exact challenge facing modern AI today. I mean, think about self-driving cars.
They've basically met the technical threshold. Statistically, many of them are already safer than human drivers.
They are. But we're still hesitant to get in them. Why?
Because we fear the unpredictability. If the car suddenly brakes or swerves, we don't know why. If an accident happens, who's responsible? The owner? The manufacturer? The software company?
That confusion over accountability, that lack of transparency into the AI's decision-making, it's the same social threshold problem as the 1854 elevator.
Or think about AI and disinformation. AI has definitely met the technical threshold. It can generate incredibly high-quality, believable text, images, videos.
But that capability creates a massive social fear. The fear of losing control over what is true.
So the analysis suggests that the solution isn't just better algorithms, it's mandated transparency and explainability.
Right. If we can't explain why an AI made a certain decision, or if we can't verify where a piece of content came from, the public will never trust it or adopt it for critical tasks, no matter how powerful it is.
So the conclusion here is vital for 2026. The ultimate success and widespread adoption of AI depends on solving both the engineering problem, the technical threshold, and the psychology and culture problem, the social threshold.
And that focus on adoption leads us right into the money. Let's move to Section 4, the application layer, where all this productivity is supposed to pay off.
This layer is so critical. The application layer is what generates the productivity, and its profits are what drive the whole positive feedback loop that funds all the expensive CapEx for the hardware, the models, the infrastructure we just talked about.
If the applications don't actually make money, the whole ecosystem just collapses in on itself.
So the core question for 2026 is, can these amazing productivity improvements actually be converted into a profitable business model?
And we've identified 5 high-impact sectors where this transformation looks poised to happen.
Okay, where do we start?
Sector 1, software development and IT services. This is the fastest impact area, bar none. AI is basically eating its own tail, making the people who create software exponentially more efficient.
We're talking about advanced AI development tools, right? Things way beyond the early versions of Copilot. We're talking about AI that... AI ops.
AI ops. AI for IT operations. Using AI to manage complex infrastructure, predict system failures before they happen, and automatically optimize how resources are allocated. It's huge.
And the numbers are staggering. This could increase an engineer's output by 30 to 50%.
That's an immediate, measurable reduction in labor costs. And on top of that, you have the rise of low-code and no-code platforms powered by AI that can understand natural language.
Which expands the pool of people who can actually build enterprise-grade applications, boosting IT capacity without having to hire more six-figure engineers.
Okay, Sector 2 covers financial and legal services.
These are knowledge-intensive fields. They're basically built on analyzing complex text and navigating huge regulatory burdens, so they are ripe for automation.
In the legal world, AI can just slash the costs of research and compliance, especially in e-discovery, which is the process of sifting through millions of documents for a lawsuit. AI can cut those costs by over 60%.
A legal LLM that's been trained on decades of case law and regulatory text can spot risks faster and more consistently than a whole team of junior associates.
And in finance, the big gains are in the back office. Automating things like know your customer checks or AML, anti-money laundering processes, and real-time risk modeling.
It boosts efficiency and, maybe more importantly, reduces regulatory risk, which can be incredibly costly.
The key investment focus here is on what are called vertical AI solutions, FinLLMs, legal LLMs, models that specialize in this highly regulated proprietary data. That specialization is what gives them a competitive moat against the big general models.
All right, Sector 3. Healthcare and high-end manufacturing.
The deployment here is a bit slower because of regulations and safety concerns, but the impact is going to be absolutely revolutionary.
In healthcare, we're already seeing big improvements in diagnostics, especially in things like radiology and pathology, where an AI can spot things the human eye might miss.
And crucially, AI is accelerating drug design. By simulating how molecules will interact and predicting which compounds will be effective, AI can save pharmaceutical companies literally billions in R&D and shorten the time it takes to get new treatments to market.
And in manufacturing, you combine AI with the Internet of Things, or IoT, and you get predictive maintenance.
This is so cool. The AI analyzes real-time sensor data from a machine, vibrations, heat, sound, and it can forecast exactly when that machine is going to break down.
Which dramatically reduces expensive downtime and allows for a much more elastic and responsive supply chain.
Okay, Sector 4 is customer service and content creation. These are the areas being directly impacted by LLMs right now.
Customer service is a pretty straightforward calculation. An AI virtual assistant can handle 80% or more of the most common customer questions.
Which frees up your expensive human staff to deal with the 20% of complex, unique problems that actually require a human touch. The cost savings are immediate and massive.
And for content creation, this really signals the death of low-quality content farms.
Oh, they're done. If an AI can generate a boilerplate article in 5 seconds, that content has zero value.
The real productivity gain comes when the AI handles the first draft, the research, the data summary, and it allows human creators to focus on the high-quality, high-IP work that requires original thought and a unique human perspective.
Finally, for any application company to succeed in 2026, they need 2 things. First, they have to deliver a high ROI.
A high return on investment. The application has to generate significant cost savings or new revenue to justify the expensive hardware it runs on.
And second, they absolutely must possess a data moat.
They need to be collecting unique, industry-specific data from their customers.
Because that data is what allows their specialized vertical AI model to become better and better, eventually becoming superior to any generic foundational model. That's their defensible competitive advantage.
Okay, so that's the optimistic side of the blueprint. Now, for the sake of prudence, we have to pivot to Section 5.
The unseen risks. The 5 black swans for 2026. So, while we are generally optimistic about AI, we have to analyze the risks that the market hasn't fully priced in yet. These are the things that could derail even the strongest growth story.
And risk number 1 is the hard stop risk, the physical limits we were just talking about.
Right. We highlighted infrastructure as this great opportunity, but what happens if the supply chain just fails to meet the overwhelming demand?
The linear physical supply of grid upgrades and these massive transformers is already lagging way behind.
So if those grid interconnection delays stretch even further, beyond the current 5 to 8 year projections, or if the transformer supply completely dries up,
huge data center projects will just be forced to pause, get canceled altogether.
And the impact of that would be a sudden, non-bubble-related stock correction across the entire AI supply chain. Not because the tech is bad, but because the ability to actually deploy it hits a hard physical wall.
Okay, risk 2, the monetization gap, or application failure.
This is the breakdown of that positive feedback loop we mentioned. Companies are spending aggressively on chips and servers. But what if the AI application they deploy only gives them a tiny efficiency gain?
Like, say, a 10% efficiency boost, but it increases their cloud service costs by 20%.
That's a negative ROI. And if enterprises start realizing they have a negative return on their AI spending, they will slam the brakes on non-essential AI CapEx so fast.
Which would cause a major slowdown in cloud service provider growth, and the market would start to aggressively question the whole premise of spending so much on AI infrastructure. It would hammer hardware valuations.
Risk number 3.
Yeah.
A resource counterstrike. This is the geopolitics escalating.
The U.S. and its allies are working hard to build rare earth supply chains that don't rely on China.
And China is fully aware of this de-risking strategy.
So the risk here isn't just about the common rare earth minerals we always hear about. It's about China retaliating by expanding its export controls to harder to replace critical inputs.
We are talking about highly specific, high-end refinement chemicals or particular rare metals that are essential for advanced batteries or for semiconductor fabrication or for defense technology.
These are niche inputs that are incredibly difficult to find or create elsewhere. It would take years and billions of dollars to build alternative sources.
The impact would be an immediate, sudden supply shock, massive cost spikes for high-tech manufacturing around the world, and serious instability in defense industries that rely on these inputs. It's a targeted form of economic warfare.
All right, risk 4, the shadow banking bomb. Liquidity.
A deeper dive into the cockroaches. We're already seeing rising delinquency rates in things like auto loans, and, of course, the huge structural risk in commercial mortgage-backed securities.
And if a whole cluster of large non-bank financial institutions were to collapse at the same time because of these defaults.
Even if the traditional regulated banks remain well-capitalized, it could still cause a system-wide credit freeze, just like we saw in 2008.
And when credit freezes, you get extreme market risk aversion. Prices crash across all risk assets, including all the high-flying tech stocks, and corporate borrowing becomes impossible.
Which would immediately throttle all those ambitious AI CapEx plans we've been talking about.
And finally, risk number 5, structural discontent and policy intervention, the Thiel effect.
This goes right back to the social threshold we covered. As AI accelerates job displacement and wealth inequality, with young people feeling locked out of housing and capital accumulation, that social pressure just becomes immense.
And that pressure could force governments towards some pretty radical, even anti-capitalist policies.
I mean, think about something like a robot tax on AI profits, where governments try to claw back some of those efficiency gains to fund social programs like universal basic income.
Or just massive antitrust regulations aimed at breaking up the tech giants that dominate the AI space.
Either way, the impact is the same. It means increased operational costs and an artificial cap on the profitability of AI applications.
That list of 5 risks, physical limits, monetization failure, geopolitical counterstrike, financial contagion, and political backlash, is pretty essential for anyone planning their strategy for 2026.
It really is.
Yeah.
So what are the final actionable takeaways for everyone listening?
Let's do a quick recap. The key action points for you, the learner, are pretty clear. Shift your investment focus toward that physical infrastructure energy, the grid, cooling, that's enabling this next phase of growth. Keep a hawk's eye on global liquidity signals, especially the end of QT, for any short-term relief.
But you have to always balance that growth optimism with the really deep-seated risks, the commercial real estate bomb and those 5 black swans we just outlined.
Here on Sip&Talk, we always encourage critical thinking. We've presented objective analysis and facts today, really focusing on the economic consequences and challenging the easy assumptions that tend to dominate the tech conversation.
We're just providing the objective facts and analysis for you to form your own independent thoughts. And we do, of course, have to add our standard disclaimers.
Of course.
The content shared today is for informational purposes only and is not, under any circumstances, to be taken as professional investment advice. Please do your own research, consult with your financial advisor, and remember that Donald Trump is the current president of the United States.
Now, here's a final thought for you to chew on as we wrap up. If the ultimate success of AI really does depend on crossing that social threshold, the whole Otis elevator revelation, and people only trust what they feel they can control, then how much of AI's future success will actually be determined by its explainability rather than its raw power? Something to think about the next time you see a new AI application hit the market.
That is an excellent point. And that is all the time we have for this deep dive into the 2026 blueprint. We want to encourage all of you to subscribe to the Sip and Talk podcast wherever you get your audio.
And please don't forget to check out our old friend Mickey's YouTube channel, Mickytolife. He's got some really fun travel vlogs and the best memes to keep you entertained after all this serious talk about CMBS.
He really does. We'll talk next time.